Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we will explore the strategic decision by Johnson & Johnson to divest its consumer health business unit, which led to the creation of a new company named Kenvue. We'll look at the reasons behind this move, its implications, and what it means for both organizations moving forward. This analysis will help us understand the broader context of such corporate strategies and their impact on growth and market focus. Let's dive in. When Johnson & Johnson created Kenvue by spinning off its consumer health division in 2023, the goal on the surface was straightforward: simplify their operations, unlock value for shareholders, and concentrate on faster-growing areas like pharmaceuticals and medical devices. However, this move was more than just a typical business decision. It raised important questions about whether the spin-off really created new value or simply shifted a large amount of legal risk away from J&J while refocusing its core growth businesses. This wasn't a small change. It involved one of the world's most recognized healthcare companies, famous consumer brands like Tylenol, Listerine, and Neutrogena, and tens of thousands of ongoing lawsuits related to product liability. The strategy invites us to think deeper about how companies use divestments, not just as growth strategies, but potentially as ways to manage and isolate past risks. This discussion breaks down the transaction to understand how and why it happened, whether it truly benefited shareholders, and what lessons other large companies can learn when facing similar challenges. After spinning off its consumer health division, J&J transformed into a focused pharmaceutical and medical technology company. This change aligns with a wider trend in the industry, where consumer health products tend to provide steady but slower growth, while pharma and biotech offer higher risk but much greater profit margins. By divesting from consumer products, J&J boosted its overall profitability and allowed its management to concentrate more on innovation in areas like oncology, immunology, and medical devices. This focus helps the company pursue higher growth opportunities and leverage its strengths in science and technology without the distraction of managing a broader consumer portfolio. The spin-off brought in about $13.2 billion in cash, which gave Johnson & Johnson significant financial resources. This capital strengthens their ability to make strategic acquisitions that can add value and growth potential. It also allows for greater funding of research and development efforts, accelerating the advancement of their pharmaceutical and medical technology pipelines. With more flexibility in their budget, J&J is better positioned to compete in the costly and competitive innovation landscape they face today. This financial boost supports their focused approach on high-growth core segments, enabling them to invest where they see the biggest opportunities for long-term success. After the spin-off, Johnson & Johnson split into two focused entities: the original company, now concentrating solely on pharmaceuticals and medical technology, and Kenvue, which handles consumer health products like over-the-counter drugs and personal care items. This move is typical for spin-offs because it helps increase strategic clarity by allowing each company to concentrate on its specific market. It also lets them allocate capital more effectively according to their unique needs and growth opportunities. This division aligns with the traditional reasoning behind spin-offs, where sharpening focus tends to enhance each entity's valuation, making them more attractive to investors and better positioned for growth in their particular areas. The talc litigation is one of the most complex and contentious issues stemming from the Kenvue transaction. There are tens of thousands of lawsuits connected to talcum powder products, with potential settlement costs that might exceed $8 billion. Johnson & Johnson has made it clear that it will retain all talc-related liabilities in the US and Canada and will indemnify Kenvue against any associated expenses. Despite this, Kenvue has still been named in some lawsuits, and courts have sometimes divided liability between both companies. This has led to ongoing uncertainty as legal risks are not neatly separated, and both companies continue to face perceived exposure in the eyes of stakeholders and the public. The images of the Johnson's baby powder and the litigation gavel emphasized the real-world impact and legal challenges involved. There are two main ways to look at the litigation risk following the Kenvue spin-off. One optimistic perspective is that Johnson & Johnson continues to bear the bulk of the litigation burden, effectively containing the risk within the parent company. Meanwhile, Kenvue can operate independently without the overhang of these lawsuits, which could help investors value each business more clearly and fairly. On the other hand, the more cautious view points out that the legal challenges remain complex and intertwined between the two companies. The spin-off might create a separation in appearance, but it doesn't fully eliminate the shared risk, meaning investors still need to factor in the uncertainty related to ongoing and future litigation. This dual interpretation captures the strategic complexity around managing and communicating risk after the separation. Following the spin-off, capital allocation priorities changed significantly between the two companies. Johnson & Johnson has shifted its focus toward advancing drug development and making strategic acquisitions that leverage its higher margin pharmaceutical and medical technology portfolio. This allows J&J to concentrate on innovation and expanding its pipeline. On the other hand, Kenvue is targeting cost efficiency measures, aiming for approximately $350 million in annual savings and focusing on expanding its core consumer health brands. Kenvue's investor base is more dividend-oriented, so the company emphasizes steady cash flow and operational efficiency. This clear separation in capital strategies reflects the distinct business models and growth opportunities for each entity post-spin. Kenvue operates with an operating margin around 21 to 22%, showing a solid margin, but facing some periods of declining sales due to broader economic pressures. It's generally seen as a defensive business with stable consumer demand. On the other hand, Johnson & Johnson has improved its margin profile since the separation, benefiting from greater strategic clarity and focusing on pharmaceuticals and medical devices. This sharper focus also gives J&J increased financial flexibility, which supports its ability to invest in innovation and acquisitions. The two companies now have distinct profiles. Kenvue as a stable, consumer-focused business navigating some sales challenges, and J&J as a more agile, higher-margin entity with stronger strategic direction. There is a clear divide among investors when it comes to valuing Kenvue. On one side, some believe the company is undervalued, trading at around a 38% discount compared to what they see as its intrinsic value. These investors often focus on Kenvue's stable consumer business and potential for steady cash flow. On the other hand, skeptics raise concerns about Kenvue's growth prospects given market pressures and competitive challenges. Litigation risk, particularly the talc lawsuits related to its products, remains a significant overhang, causing further hesitation. Additionally, questions about the company's ability to maintain strong competitive positioning in the evolving consumer health sector add to the uncertainty, making the valuation a subject of active debate. The Kenvue case offers a practical example for big corporations thinking about strategic divestments. The first step is to clearly define the objective, whether that's accelerating growth, improving margins, isolating risks, or reallocating capital. Being specific about these goals helps guide the entire process. Next, it's important to carefully separate assets and liabilities. This means explicitly assigning liabilities, such as through indemnification agreements, to ensure full legal clarity and avoid any confusion or overlap between entities. This careful planning reduces uncertainty and supports a smoother transition, helping both the parent company and the divested unit operate confidently and independently after the split. J&J made sure the transaction was tax efficient by executing a tax-free share distribution to their shareholders, which helped minimize tax liabilities during the split. Next, they established a completely independent operating model for the new entity, putting in place a dedicated management team, a standalone capital allocation strategy, and a clear strategic identity to ensure each company could operate effectively on its own. Finally, they focused heavily on communicating the value creation story to investors, explaining why the separation would enhance overall performance and how each company would be positioned to succeed independently. This clear communication helped investors understand the rationale and potential benefits behind the split, making the transition smoother and more transparent. Abbott Laboratories separated its pharma and diagnostics businesses, creating ABBVIE, and both companies outperformed significantly after the spin-off, showing how focus and independence can unlock value. Pfizer divested non-core units like Zoetis and Viatris to sharpen its focus on innovative pharmaceuticals, demonstrating that simplification improves strategic clarity. Merck carved out slower growth segments through its spin-off, Organon, prioritizing a high-margin drug pipeline, which reflects how portfolio optimization has become a core strategy in pharma. Johnson & Johnson spun off Kenvue, taking a similar approach by divesting a stable but slower growth consumer business to concentrate on innovation and capital intensity. However, Kenvue's value story is complicated by significant legal challenges, which highlight an important difference compared to the other examples. Altogether, these cases illustrate how strategic divestments can help companies realign, focus on core strengths, and drive value, although each situation has unique factors to consider. With the spin-off, Johnson & Johnson is now focused more sharply on healthcare innovation, operating as a streamlined company. This focus has improved margins by removing the lower margin consumer division, which helps profitability. Additionally, the spin-off gave the company $13.2 billion in cash, increasing its ability to make acquisitions or invest in growth opportunities. Investors also benefit from clearer choices. Growth-focused investors tend to prefer J&J's healthcare innovations, while those seeking steady income might lean towards Kenvue's consumer business. Finally, spin-offs like this often unlock additional value, as they have historically outperformed in their early years after separation. One key challenge is the ongoing talc litigation, which remains unresolved and adds complexity in determining liability. Execution risk is also significant. Kenvue must show it can grow on its own, while Johnson & Johnson has to meet its pharmaceutical growth goals. Investors are skeptical, questioning whether the spin-off will truly create value and sustain growth over the long term. Additionally, J&J is losing a steady consumer revenue stream, reducing its diversification and potentially increasing volatility. Finally, if Kenvue underperforms, the expected increase in shareholder value might not materialize, which means there is a real risk of value leakage after the separation. Overall, these risks highlight the importance of careful management and clear strategy post-spin-off. The Kenvue spin-off represents a shift in how companies approach divestment. It's not just about cutting costs or improving efficiency anymore. Instead, it's about repositioning the business to better handle capital needs, focus on growth areas, and manage risk more effectively. However, there's a clear tension here. While a company can separate its assets and operations, separating legacy risks like ongoing liabilities or past legal issues is often much harder or even impossible. This highlights the complexity involved in strategic divestments, where you can create new, independent entities, but still carry forward some risks that can't be fully isolated. This insight is important for anyone considering a similar move, emphasizing the need for careful planning around risk management alongside growth and capital considerations. The spin-off of Johnson & Johnson's consumer health unit into Kenvue is a major example of how companies can reshape themselves in the healthcare sector. On the positive side, it allows Johnson & Johnson to focus more on its core pharmaceutical and medical device businesses, giving it better strategic clarity. It also provides more capital flexibility, freeing up resources to invest where they matter most, and leads to improved profit margins by removing a lower margin business segment. However, this move isn't without challenges. There are ongoing legal issues, especially related to litigation that still hangs over the consumer unit, making the separation of liabilities complicated. This creates uncertainty for investors about how those risks will be managed long term. Additionally, the spin-off sends mixed messages about future growth, as both companies now need to prove their ability to create value independently. So, While the restructuring presents clear benefits, it also introduces new complexities that must be carefully navigated to ensure sustained success. Whether this spin-off creates real shareholder value will come down to how well the two companies execute their strategies. Johnson & Johnson needs to successfully reinvest capital into its higher growth pharma areas, while Kenvue has to stabilize its growth and handle ongoing legal challenges. If both achieve results that surpass their combined value before the spin-off, this will be seen as a strategic success, a clear example of smart focus and capital allocation. However, if they fall short, it might be viewed as a complex restructuring that changed market perception without fully addressing the risks involved. More broadly, this case highlights how companies today redefine themselves by balancing growth, risk, and capital efficiency, making the spin-off more than just a divestment, but a reflection of modern corporate strategy. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.